Everyone, Douglas here, Kenner Market Analysis, and welcome to the macro update for Tuesday, June 16th, 2020. It is 7:35 a.m. Eastern Standard Time as we get things underway, and we obviously have a lot to take a look at today as markets continue to recover from that big sell-off that happened last Thursday. Obviously, much in line with kind of what we thought would happen after that sell-off. A little bit of worry there, but all things considered, it definitely looked like we would probably find some support, but we are now at an important inflection point, so we will definitely look at the S&P chart here at this point and kind of dive in a little bit more detail on where we're at right now and kind of what I'd like to see going forward after we look at all the data. But where I want to start with, or what I want to start with today, is a continuation of the discussion that we started 2 weeks ago when we were taking a look at essentially how funds flow through the economy from a very broad standpoint, and really starting with the federal government, just to get a deeper understanding and a better understanding of really how I kind of see markets working and how money ultimately flows into markets, and particularly in the assets that I look to trade, how a deeper and better understanding can give us a better grasp of where things might go next. So we're going to go back to our flow chart that we created and continue to build off this and take another look, or take kind of a different look at a few other things that are kind of important to understand. And so just a quick recap during the last video, if you want to, you can find, again, that was the macro update 2 weeks ago. If you're watching this on the YouTube page, it was the government debt video from 2 weeks ago. Yeah, you can check it out there. Anyway, onto the details of what I want to talk about now. So when we started this off, we were looking at the federal government and how it really kicks off all the flows of money throughout the major sectors of the economy that really allow everything to happen. And so we kind of dispelled some myths and got a better understanding of maybe why following things like the deficit and particularly the recent deficit explosion that we've seen can help us really understand how it might benefit the financial economy here going forward, and why it really shouldn't be too much of a surprise kind of from, again, this style of model that we're seeing, the sort of at least financial recovery that we're seeing going on. One of the sectors, and this is what I want to talk about today, one of the sectors that we kind of left out of that discussion was the foreign sector and what's happening there. We kind of put placeholders, and I thought it would be a good time as any to, in this kind of broader discussion of everything that's happening, to go ahead and take a look at the foreign sector. And the reason I want to take a look at the foreign sector specifically today is because recently, this past week, I saw this chart right here showing this graphic showing foreign holders of U.S. debt. This is tweeted out. I saw it a handful of times tweeted out, and usually with the kind of commentary attached to it that this should be some sort of worry associated with it. Also seeing Japan retake China as the largest treasury holder. That was oftentimes a point made, but usually this gets brought up in the context of some nation owning U.S. debt in usually kind of like a wary context, right? That there's some sort of impending doom because of this, that maybe China or Japan or any of these other large holders of U.S. debt might not have the best interest for the U.S., and this might be a bad omen, if you will, for the U.S. economy. And I'll just jump to the point and tell you that I think this fear is way overblown, and especially when you kind of understand how, again, funds flow through the broader economy and through the different sectors in the economy, what the outcome of this actually is and what the implication of this actually is. And so that's where I'm going to ultimately end, is kind of on there might not really be as much to see here as I think some people would like to see. And to a certain extent, I'd love some big punch of, here's some deep insight, but the deep insight is there might really not be all that much insight to be gleaned here. And especially from a trader perspective, right? There might be some political implications, some economic implications in terms of policy-wise, but in terms of what this has to do with the financial economy for those of us who are looking to invest and trade and get some insight, I don't think you're going to find all that much help worrying about who holds U.S. debt. So let's jump back to our flow of fund chart and focus in on the foreign sector. And I think there's a thought or a belief that take China, for example, that the reason China has amassed so much debt is because there's some direct connection between China lending the federal government directly money, right? I know at one point in my life that's probably something that I thought was happening, right? That the U.S. was buying this, that China was buying this debt that the U.S. just absolutely had to have so they could fund their spending. And as we noticed last week, that is not a step that's ever necessary, right? The first step that has to happen is the federal government has to spend that money into existence, and then that can kind of kick off the flows going through the economy. And so if this isn't happening, right, and actually before we go any further, let me prove to you that this isn't happening. In case you're wondering, we can actually go to the balance sheet of the Treasury, and you can click right here on cash and other monetary assets in the Treasury balance sheet and see that foreign currency on the Treasury balance sheet is only about $15 billion, far less than the trillions and trillions that if the first theory was true, right, that the other central banks were in some sense buying U.S. debt, they'd have to be buying it with the only currency they have available to them, and that would be their own currency, right? That's how it would happen. So the Treasury is not accepting renminbi for treasuries, and you can also check the balance sheet of the Federal Reserve as well. There's not much foreign currency on the books of the Federal Reserve either. Again, a lot of this for the Federal Reserve is for currency swaps, and on the Treasury, it's for intergovernmental agency kind of situations. If you have to buy something foreign or whatever, that's why that money is there. But it's certainly not in any way to fund spending. So, of course, they're buying these bonds, they being China or Japan, they're buying these bonds with U.S. dollars, right? Which then begs the question, how did they get these U.S. dollars in the first place? And hopefully, if this is kind of new to you, there's some light bulbs turning on right now, and you can kind of see where this is going to go. So we're going to switch back to our flow of funds diagram, and what's happening is how China has ended up with the bonds that they, or the U.S. debt that they have, is China is selling goods and services. So we're going to go ahead and delete this two-way line. They're selling goods and services to the private sector. So maybe cars. I know they're maybe not the biggest exporter of cars, but we'll say Japan is selling cars to households, and China is selling, say, services to the business sector. And obviously a lot of the things that I as an American have laying around in my house is made in China, and so that's what's happening. They're selling goods and services to the private sector in the U.S., and the private sector is in return giving back currency, in this case dollars, because that's all we've got to give back to this case Chinese manufacturers, in our example, Chinese manufacturers. So that's what's happening, and that's how China is getting the dollars to begin with to repurchase these bonds. Now, there is a series of steps specifically in China that's unique to them, and that any manufacturer will take those dollars, and those dollars will ultimately end up through a handful of bank transactions onto the balance sheet of the central bank. It's a little bit different in other nations, but essentially that's what ends up happening. Those dollars go into the central bank, and then at that point, the central bank has the foreign central bank has a spot on the balance sheet of the Federal Reserve, and their Federal Reserve bank, and they will call up whoever it is they need to call up, and they'll say, hey, we have $1 trillion or $1 billion, whatever of dollars here in my account. And can I switch those from dollars into bonds? I'd like to purchase bonds with those, and the central bank will then do their interactions or their transactions necessary with the federal government. That swap will happen, and now China no longer is holding dollars, but instead they are holding treasuries now at this point. So that's the actual kind of mechanism that is occurring to get treasuries, to get U.S. debt onto the balance sheet of foreign nations. They're accumulating dollars through ultimately exporting goods and services to the private sector of the U.S., and they're making the decision to go ahead and save those dollars in the form of really interest-bearing accounts as treasuries, as opposed to using those dollars for other purposes. And if you go back to the little diagram here that's showing all the held debt here, a lot of these, the two main ones, are major exporters over the last, say, 30-40 years to the U.S., right? They've exported quite a lot of goods and services, received dollars for that, and have decided to go ahead and save those dollars as bonds. So I know that's a bit of a kind of anticlimactic reality, and I know that's not as kind of exciting as kind of the narrative that you have China, buying up this debt to, in some sense, influence the U.S. But that is what's actually happening in terms of the actual kind of mechanical, movements of these dollars through the economy. And again, I really think if you really want some big takeaway in terms of, why, what some implication might be of this, you really kind of have to look at really the nations that are choosing to go ahead and hold bonds over actually using those U.S. dollars for broader investment purposes. And there may be good reason for this from kind of monetary policy side of things, to have a large reserve base as you're building up your economy. I know China set out to do that, so as they were really building up their economy, going from the 80s and through the early aughts, that they would have that kind of stability to their own currency as they set to meet out what it is that they wanted to do, their ultimate goals and ends in terms of what they wanted to do economically. And there might be, some positives or negatives for doing that, but that is really where the question lies. Another way to look at this is that it's very easy for the U.S. to export dollars, right? Again, as we saw, the federal government is the creator of dollars, and it's very easy for them to create them. It's ultimately just keystrokes that are going to do that. And from a policy perspective, obviously not so much related to the financial sector, but from a policy perspective, that exchange, in my view, is a win for the private sector in the U.S. If someone is willing to make something, give that to another nation, in this case the U.S., and all the nation has to do is export dollars, export something they can create with just keystrokes. In terms of the opportunity cost there, that's a big exchange, right? That's occurring, or a big really gain from the exporter of the dollars and what they ultimately import, the goods and services that they import. And that should be a policy discussion, right? That who's benefiting from all these imports coming on in, and to what extent is the real cost happening there in terms of how we're obtaining these. Now, there's obviously the flip side of that, and we're seeing that right now as the coronavirus pandemic is playing out. That sometimes the shipments of goods and services can break down, and then obviously you want manufacturing base that's able to provide your essentials and your necessities in the case of an emergency. That discussion notwithstanding, the idea that that there is this exchange between really a zero opportunity cost good, in this case dollars, for a high opportunity cost good such as cars or laptops or whatever, is really happening. There should be some policy discussion as to who's being able to benefit and how they're being able to benefit from that. But particularly from the financial sector, there's very little involved here in terms of this whole transaction of who's owning U.S. debt. One thing that I think I'll point out real quick, just to kind of tie this up, because it should be maybe a question kind of hanging out there, is what about those dollars that ultimately get or that don't get exchanged for treasuries? And a lot of those dollars are going to end up in the financial sector. Either another financial sector that we should maybe put out here. This would be the global financial sector, or something that is often referred to as the Eurodollar system. You've oftentimes heard of. A lot of dollars end up out there. Same with the treasuries as collateral. That's a whole different discussion. It's worth having. We'll kind of go down that path into the future. But you do see a lot of money head out there, and oftentimes referred to again as the Eurodollar system. Very much the shadow banking system exists out there. So there's where a lot of dollars will end up that don't end up in this kind of exchange for just U.S. debt. So yeah, I mean that's essentially what's happening here. It's really quite simple and really quite benign in terms of what's actually behind all this. And I think that's really the big takeaway that I want to have from all of this. Is I think oftentimes there is a sense of fear when you see who's holding and how much U.S. debt presented, that this could create some sort of calamity, that nations would have some sort of control over another nation because of the debt that they're holding. And insofar as a country is the sovereign creator of their money, they don't have it backed by anything. They have a free floating exchange rate. There's very little that foreign sector holding that debt can do to in any way do anything to the nation of the debt it's holding, and the implications are again quite benign on the financial sector. Now, don't get me wrong, if China or Japan decided to literally dump every treasury they had tomorrow, and that news headline came out, that could cause some issues in the short run in the financial sector. Certainly, even the headline alone might cause some instability, but it would be short-lived, and we would see a very quick recovery from whatever came of that. So I don't want to say that there couldn't be a scenario where some sort of news event really kind of caused some short-term issues, but it would resolve itself in a short amount of time, and we would see a resumption of normalcy after that. So I'm going to end this discussion here. I hope that was helpful, and if you have any follow-up questions, by all means, please feel free to ask them. We're going to start stepping into a little bit more complexity here as we go on in this series, and so if there's anything that you feel needs a little bit further explanation, feel free to ask, and we can definitely check that out and kind of elaborate further. All right, that's going to wrap things up for this preview look at the macro update. And if you like what I'm doing here and you haven't yet subscribed, make sure you do that. And if you found this video particularly helpful, give it a thumbs up as well. And if you really like what I'm doing here, you're an active trader, active investor, and this approach is something that intrigues you, by all means, check out my Patreon page over at patreon.com/CannonMA. Multiple extended updates every week. All my trades get posted there as well, so you can follow what I'm doing. And so far, we've had a very successful year, all things considered, and up almost 30% on the year. So churning right along in terms of kind of where we're at success wise. So pretty happy with how things are turning out. And I think the second half of the year, can't believe we're already here, but I think the second half of the year definitely has some opportunities in front of it, as well as we forge forward through what has been obviously a very wild 2020 so far. So with that being said, I will wrap things up here. So good trading, everyone, and we'll see you next time. Bye bye.